Hi, I'm Steve Van Metre, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to figure out what's going on with the markets that just don't make a whole lot of sense right now. But we'll try to figure it out anyways. Now, because Friday is Good Friday, the markets are closed, stock and bond markets. I presume I'm going to be closed as well. And with that, we won't have all the government data we usually go over. We won't have any market stuff to go over. So what I'm going to do is this one may run just a little bit longer. I'm not going to do a lot of monologue. We're going to go right into the PowerPoints and then over to the graphs, kind of take a look at what I see going on there. If something interesting happens on Thursday, I'll put a video up, but otherwise we'll just assume that without government data on Friday and no markets open, not much to say. So let's get through the disclosures real quick. The content of this video is provided as education information only. It's not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video or that alone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's go right into the stuff I've preened off the internet. S&P 500 companies in a blackout period. We are right here. Thursday will be here, and then this will start to taper off as we get through the month. This is why trading volumes are so low, because corporations aren't buying their stock back because, well, they can. There's a limit, but they cannot be flagrant. There's a what they call, for lack of better terms, an amount that you're allowed to buy no matter what, and then there's amount over that the amount over is what's being blacked out right now. I think it's called safe harbor is the words I was looking for. Anyways, this is a really cool chart from Macro Bond and Nordea. The Empire State Manufacturing Future General Activities Index against the S&P 500 price return, and you can see these two are generally very well correlated. When one is going down, the other one is soon to follow. And right now, the total return of the S&P 500 is up, whereas the Empire State, this would be New York State manufacturing data, is saying, well, yeah, stocks, you should be headed lower. In fact, you can go back to what should have been a recession in 2016 and see that we're just shy of that. And below that, we have the dot-com bubble, the mortgage bubble. Hard to think the economic data is down here at the third lowest level on this chart, and stock prices are up here. It just tells you the stock market does not always see recessions coming. This is a cool chart. I've tried to make one myself, but I have trouble inverting government data properly. But anyways, this is the U.S. Treasury yield curve, the 2-year, 10-year inverted upside down. And what it's saying is volatility, or the VIX, should be a whole heck of a lot higher. And so the move higher in volatility should bring a much lower stock prices with it. This is a really cool chart from Refinitiv and Credit Suisse. The corporate sector has been the main buyer of equity since the market low. Going back, they went all the way back to the bottom of the market in 2009, and you can see non-financial corporates, companies buying their stock back up, and up. The rest of the world doing not a whole, they bought some and then sold some. Households, so average people, they were buyers and then sellers, and they pretty much have been net sellers. And then last we have institutions. These would be pension funds, large institutional money managers, and they have been selling stocks. So there you can see, if there's any doubt of can the stock market go higher, let's just put it in context. Then you want to see the corporate tax rate go to zero. You want to see corporations lay people off, still do a ton of business, because the only way they can buy stock, they continue to buy their stock back at this pace, is if they have the money to do it. They cannot borrow money indefinitely to do it. They don't have the cash flows indefinitely to do it. But now you know another one of the reasons why I don't buy this market goes up forever. I don't buy that it goes up for 10 more years, because corporations cannot continue to buy all their stock back. I mean, if they do, they're going private. So then that kind of wipes out the whole notion of having a stock market if everybody is private. So the reality is this is not going on forever. Now, if you look at the weekly insider transaction reports, which might as well be called the insider sales reports, because there's hardly anyone ever buying on these weekly reports, they are just showing all the top executives. I'm not looking at all of them. I'm just looking at the top executives across major companies that household names, are selling. And they've not just been selling for the last couple of weeks, selling for like the last year. So they continue to unload their stocks to their corporation who is buying them back. This retail sales is coming out tomorrow. So this is the dollar volume growth based on the first data merchant services. This is chart was posted by Teddy Valee on Twitter, Vallee, if you're looking for him. And you can see a big jump here. So this could be, the post tax refund effect. So his thoughts were, will there be a surprise to the upside for retail sales tomorrow? Well, that would be interesting if there is. And I think, this is our last slide, is the City Economic Surprise Index. Now, the City Economic Surprise Index, and we talked about this before, but just to refresh your memory, is let's say that I'm going to predict that retail sales is going to be up 0.1% month over month. We'll just say that that's my prediction. It's not, but we'll just pretend. Now, let's say that the actual number is plus 0.3% month over month. Well, there is a weighting of how much I was wrong on my estimate, on the upside or on the downside. Now, when the City Economic Surprise Index goes down, that means I am overly optimistic as an analyst. When a City Economic Surprise Index is going up, it means I am overly pessimistic as an analyst. And they gauge a large pool of analysts, and they make this chart. Now, so what we're seeing is analysts have been wrong to the wrong. They've been predicting growth from various economic indicators, and they have been wrong. So the surprise index, is surprising to the downside. And when stocks rise against a falling surprise index, because these two are usually fairly well connected, well, it's not the economic data that goes up. It's the stock prices that go down. And you can see that this rally here, borne by corporate share buybacks, has driven the market up against declining global economic data. So that is not a good sign for the market. All right, so let's clear that off my screen and go right over. And we'll just, let me get that reset. And let's just go through all the charts one by one. And maybe we'll do this in 15 minutes. Who knows? All right, so let's take a look at the S&P 500. Now just about, was earlier today, just a mere 23 points away from its all-time high. Now closed at 2,900, so remains 40 points from its all-time high. And again, it should be way down here. Now I want to show you a correlation that I saw today, and I almost forgot, but I guess my memory's doing okay this afternoon. And wood is a lumber. It's the lumber ETF. So if you want to buy lumber, you can buy wood. And you can see how well the S&P 500 in the green and red bars is correlated to the lumber index, wood prices or lumber prices in purple. And you can see that lumber has not recovered. In fact, it seems to be following that economic surprise index a lot better than the broad market. And so what this is telling us is that when these two are wrong, wood is right. So here the S&P was going down, wood was going up, and wood was saying, hey, you need to be going up. And then all of a sudden wood started selling, and boom, there goes stock prices. Wood has been flat, kind of matching U.S. Treasury yields, and the S&P 500 has gone up. In fact, just for fun, and I did not check this earlier, so we'll see. I'm not entirely close correlation on the long term with 10-year Treasury yields, but let's zoom in. So here on a 2-year scale, it's kind of predicting exactly where 10-year Treasury yields were headed on a shorter term basis. Let's zoom into the 1 year. I like the 2 year. I mean, it looks relatively close. So it's saying, hey, lumber prices are rising, inflation's rising, there goes interest rates. Lumber prices are falling, interest rates are falling. And now we're seeing lumber prices falling, so that tells us that interest rates are more likely, again, headed lower, along with all kinds of other reasons we've described as why interest rates are headed lower. The NASDAQ 100 did make new all-time highs today. That's just worth touching on. Let's look at the volatility index at VIX. It is came down to below 12 and then bounced back up above 12. It's historically very, very, very low. And based on the based on the 210 yield curve, 2-year, 10-year treasuries, this should be way up here somewhere is where it should be. Looking at the VXX ETF, the volatility ETF that you should never buy unless you want to lose all your money. This is at not quite historical lows, but it is extremely low. And investors have been shorting volatility, buying stocks, looking to make excess return. And this thing should be way up here somewhere along with the VIX. Let's take a look at 5-year Treasury yields. We'll zoom in on this. And they closed just over, of course, this is always 30 minutes delayed. So they may have closed right on their 50-day moving average. I didn't bother to look, but they're real close. And we know that rallies start with a cross of the 50-day and a reconfirmation. So here's our potential reconfirmation right here. Here's 1, here's 2. Let's look at 10-year Treasury yields. They actually closed right on it. So again, a cross. So let's say you weren't bullish on U.S. Treasury bonds and it's fine. You said, okay, I will wait. Here's your first confirmation. Here's your second one. Assuming this holds up, and it should, yields will head lower. And again, I mentioned somewhere right in here, don't be surprised if this thing runs up to around 2.6%. And it did. Investors are ignoring the auction results, ignoring the economic data. They're just shorting the bond market. And what I did is down here, I drew in this channel. So we can see now it bounced off the upper end of this channel, kind of goes right into here. So now we have the proper channel design. I could draw this one in a little bit better probably if we went like somewhere right in here, probably is a better fit for it. And then I just drew this dotted line in the middle because it kind of matches with these tops in here. And sure enough, that was a brief point of resistance, then became support. And that should break down, and we should see a retest of this lower bound here. And I assume that will break through and ultimately drag stock prices down, because stock prices are correlated with the bond market, even though they aren't at the moment. From a trading volume perspective, volumes remain real low. Corporations are the only buyer. If you weren't convinced, go back, rewind, and look at that chart of who's buying, and everyone's selling except corporates. They're the only people buying. So right now, if you're buying this market, you're betting that corporations are going to be able to continue to buy their stock back at $1 trillion a year, because they've been buying they bought $1 trillion last year, rumored to be buying $1 trillion this year, and we're still not at new all-time highs. It's mind-boggling that much money can go into the stock market and still not drive new all-time highs. So keep that in mind. If you're buying at these levels, you are literally betting that corporations are going to make massive profits and dump that into their shares. However, when you're in a monetary deceleration, there's less money to go around. Less money means less earnings. Less earnings means less profit, and less money to go to corporate share buybacks. Hence why all these insiders, these what are called C-suite executives, CEOs, CFOs, COOs, and whatnot, are selling because they know the real numbers. They know what is coming. All right, let's go look at gold futures here. And we'll zoom out just a little bit so we can see the bigger picture. In fact, let's go out 2 years. Well, let's go out a little further for fun. So here we see this big, long pattern. And I said before, when gold gets into these bottoms, it needs to really ramp and run. And it very rarely gets up here without coming back down and then making a second run at it. So you see it kind of looked like it was going to break out here. Then it came all the way down and it just couldn't get there. So when it got up here, I wasn't convinced that this was the big breakout. And sure enough, it's not. We see this left shoulder head, right shoulder pattern. It broke through 1285 as classical chart, as Peter Brandt suggested it might. And he said if it does, it is bearish for gold, and we'd be looking at somewhere between 1200 and 1250 as a price destination. And so it broke through. It's below its 100-day moving average. This next destination is going to be this 1240 to 1250 range, where you see support at this tan line, which is the 200-day moving average. Now, what does that spell for gold mining stocks, which I think are going to be the next big bull market, will be the physical metal? Now, look, if you don't believe me, how do you get out of debt problem? Austerity, good luck. Tell that to all the baby boomers that are retiring, or you print money. I know legally we can't do that right now, but laws can change. They can. You'll see. They probably will. it'll be a dangerous deal. But anyways, here's GDX, large gold mining ETF, tagged its 100-day moving average and bounced off of it. If it was following the gold miners, it is the gold miners. If it was following physical gold, it would be somewhere down here. Look for this to fall. I expect it's going to break through its 200-day moving average. That will elicit some selling down into this range here, which is kind of where I wanted to buy before, but it was really, when it crossed its 50-day moving average, it looks like it's confirming it here, but it took too many dips below, and it didn't confirm it here. This was sloppy. I mean, this whole move up was rather sloppy. Well, it wasn't what I was expecting it to be, but I would, now that I know this is where the smart money was buying, I would have no problem starting to buy in down here if we can get and I'm pretty sure we will get back down here in the pretty near future. Silver miners are leading the pack. They broke down their 50-day, 100-day, and 200-day moving averages, and guess what? They're coming back down. And I've said this before, the silver miners are a better proxy for where the gold miners are headed, and sure enough, they're leading the charge down. That tells us that the gold miners are headed this direction. Let's take a look at oil and gas producers. I'm a bit surprised they did get up to this resistance level. Not surprised they rejected it. If we look at the crude oil builds, they've been building for the last couple of weeks, and this week we saw a draw, but we've seen 9 straight weeks of gasoline draws, and we're seeing virtually hardly any draws on crude oil. So there's something going on here that says that the supply and demand dynamic, there's something just we can't see that I just don't know enough to look at. But you would expect that crude oil should be having just massive draws right now, and it's not. So it's pretty interesting. Oil is trading in the sitting around $64 a barrel. Seems a little high based on what the economy is doing. I expect a reversal there, especially when we looked on Monday at the commitment traders report and saw just how many people were bullish on oil. But this should roll over. Anyone who thinks that you missed out on this opportunity, not really, because it crossed its 50-day barely, struggled with it, crossed it. It's still got to reconfirm here, but most likely it's going to reconfirm this low, and I think it breaks through that low as a broad stock market gives up. In fact, I just noticed something. Let's do for fun. Let's put lumber up here, not wood. Wow, look at that. Let's see, 2 years. Isn't that interesting? Let's go out further to 20 years. Yeah, there we lose our correlation. So on the short term, at least over a 2-year period, you can see that lumber is telling us that oil prices are indeed headed lower. If there is a correlation there, I mean, it looks pretty decent. I'm not going to go on record saying that is an absolute correlation, but looks pretty good. On the way down, emerging markets, I'd still like to see get down here. I don't know what's driving this other than excitement over China's fake numbers, but nevertheless, people seem to think the dollar is going to head down. It probably is going to, but don't be surprised if it gets one last push higher. Here's the 7 to 10-year Treasury bond ETF. It's closing pretty much right on its 50-day moving average. So again, across, got a little sloppy below here, but managed to get back up, and now it's looking like it's trying to confirm the 50-day again. This would be, again, further validation that, yes, we are in an uptrend on bond prices, and we can go back and look at other points where you see it kind of goes across the 50-day way up, confirm, there's your confirmed uptrend. Here you go, cross, confirm, still in the uptrend, and you can see all down here is just reconfirming the 50-day moving average all the way up. So this is a nice setup here. I like this. Let's take a look at the dollar. I mean, dollar is just not selling off. It's looking like it's about to break out up in here to this 98, 99 zone. Let's go out a little further. That would be bad news for stock prices and bad news for gold, but I'm okay with gold going down because I think it looks at this point the dollar's going to go higher before it goes lower, and then once it makes its final blow-off move, then it rolls over, and that's where we see the gold and everything else take off. Looking at the ags, which would also help on a weaker dollar, they barely got over their 50-day. I don't count this as a meaningful move with the 50-day moving average. It held here yesterday, down here on news of no trade deal with China, and then there's news of a trade deal with China by Memorial Day. Who really knows? We've been hearing that for over a year, so you can't take that to the bank. But people still like selling this despite all the bad weather that's hit the growing region in the Midwest and the crop damage from around the world. So we'll see what happens. There's no doubt the seasonality for this is right. As soon as the USDA gets in there and starts saying how much crop damage there is, and you notice there wasn't much, I didn't see any reports out of the storm that hit the farming region. I don't know if you did, but I didn't. Granted, I don't watch the nightly news that much, but just in general, I didn't see hardly anything on it. So pretty interesting, but I think obviously the seasonality, we know based on the solar cycles, this thing does take off. I mean, anyone who's lived in the Midwest for a good part of their life, they already know this. So anyways, we'll call this our update for the week, unless I said something interesting happens either tomorrow or even on Friday that would make me pull out the camera. We'll do that. Otherwise, we'll just assume there'll be no update on Friday, but we'll be back Monday. I hope everyone who's watching has a happy Easter. I'm Steve Van Metre. Give me a call, send me an email. I'm here for you. Bye now.